Merlin Show. It is your Wednesday edition, a special Wednesday. Normally I do the shows solo, but every now and again I'm graced by having some fantastic guests on the program to give us some perspective on different viewpoints of the market, as I know many of you are probably getting sour at my opinions and the way things are going. Maybe not sour, it's not maybe the wrong word, but I'm getting stale with my content. And here to help me freshen it up a little bit is my friend who is he's the trader education lead over there at Bar Chart. Of course, I'm talking about none other than Mr. John Rowland. John, how you doing, my friend?
Hello, Merlin.
Hello. How are things on the East Coast today?
Spring has sprung and it's getting exciting to get outside and have some nice weather. So it's nice to be on the East Coast instead of the left coast or West Coast.
I can tell you've been working a lot more because I didn't see a lot of ski pictures this winter. Normally, I see all kinds of pictures from you skiing, and did you hurt yourself? You know, what's going on?
No, you're right. It was kind of a weird year. I felt like wanted to take a year off, and my granddaughter is getting to the age where she's 4 now, and so we did a lot of local stuff, but we didn't do any big trips this year. So, but maybe next year.
Maybe next year. All right. Let's start off kind of high level here and work our way down to some of these other topics. Wanted to get your take on the big picture, kind of where we are now, where you see things going, because there's a lot of people panicking, a lot of people freaking out. Of course, when you have a 10% up days and 6% down days, that tends to precipitate a bit of fear. But love to get your take on what you see going on in our markets today.
Yeah, I think that's a great point. I think when you are in these moments of uncertainty, especially in moments of huge volatility, I feel like what happens to a lot of us as traders, and I think we can all admit that we've fallen into this trap, that we kind of get sucked into like a vortex where we're getting using lower and lower time frames. Maybe we're using more daily as our trend time frame, but we're looking at daily trends over 5 days or 10 days, and we don't take that time to take that step back and look at the market from a big picture. So I asked you to kind of put up a chart of the S&P, which goes back to the great financial crisis of 2008. And my thesis here is kind of, this was the beginning of that great monetary experiment where we had near zero inflation, near zero rates. And this the pumping of liquidity into the market. And then if you just do a simple Fibonacci retracement from that low to our most recent high, and we look at where the market has pulled back, well, you can see this recent sell-off fell to that 23.6 level. That's actually a very constructive level in a longer, bigger picture bull market. So if we look at it from this aspect, yeah, in the moment it feels very difficult and hard and bare and all those cliches, but in the big picture, this is a correction, something that we were well overdue. And, as long as things don't get worse, then, maybe what we do is we trade a little sideways here for a while. And then, we continue on, the path of what we see in the stock market over the longer period of time. Now, let's say even the market something happens and we do get some bad news or something does get a little bit worse. Even in that genre, right, we can see that, the 38% retracement would bring us down to like around, 4,000 or 4,200. Now, I know that seems like an extreme from where we are, but if you think about where earnings are, and I think maybe we should talk about earnings as well,
sure,
but where the expected earnings are for the S&P, somewhere around $275. That would put us at a forward earnings multiple of around 15x, which is more like a historical level for the S&P. So even in that aspect, as bad as that seems, that price falling, that would probably put the value of the S&P at a very bargain basement price, which is good for us because this is what we need. We need this opportunity to look for, some buying opportunities, so to speak.
Sure. I'll read out the numbers here. So you guys are asking in the audience about what those numbers are. The chart I'm showing here, since the podcasters can't see it, is going from those lows back in 2009 with the March lows all the way to our high we just had a couple weeks ago, actually a few months ago. And, that takes us to that 23% retracement, which is right around 4,850. That's the number he's talking about. It is a logical bounce point. And you'll notice that back in 2020, two, we did the same thing. We had a pretty decent sell-off, and a lot of people were freaking out about that. And then we stabilized and started to make some new highs and keep on going. The 38% retracement that John's alluded to was right around 4,053 on this chart on the SPX. So those don't become, like concrete points where price has to move. But psychologically, Fibonacci, I do believe, has a significant place in the markets as adding to a potential area of support, resistance, supply, demand, if you want. And you'll notice that those lows back here from October of 2023 are right about there. So there's going to be people who draw out their demand zones going from about 4,200 down to 4,000. You now have confluence with a second indicator, Fibonacci, at 38%. That does start to draw more attention, at least for me anyway, as a pretty strong target point for the fall, as well as a bounce point for prices moving up.
Yeah, exactly. I think that's a great point, this confluence of evidence. And there's some other things, like if you do like Fibonacci extensions from the drive that we're now down, we get a lot of confluence around the 4150 area. And then there's another piece of structure there is go back to, remember in September of, I think it was 23, when Powell came out and said higher for longer.
Yep.
And that was really the dynamic shift in the change of the policy of the Fed. Well, we at Barchart, we kind of named it the Powell hammer because it knocked the market down. But that level ended up becoming resistance multiple times. And then when the market broke out of it, it ended up becoming a level of support. And you can go to look at a lot of different charts that were actively trading during that time, some of the bigger cap stocks. Their Powell hammers, their values during that conference, I think was the Jackson Hole conference?
Jackson Hole Symposium, yep.
Yeah, that level had a lot of significance. So now you have Fibonacci, you have, like you said, supply and demand zones, and you also have the Powell hammer. So all these things are kind of coming together there, which is why I believe if we do see something worse in the market, then this is kind of where I feel the market is going to head to.
As someone who's gone through all these books from Martin Pring and all the different, technical analysis gurus out there, what sort of, I guess, what's your perspective on changing of momentum of market? And what I mean by that is we've had this, really robust bull market for quite some time, obviously going back to 2008 lows. And it's been this sequence of higher highs, higher lows. If we take a longer term perspective and let's say maybe go 30-year range on SPX, these financial market crashes that happened in 2000, the infamous dot-com bubble where we fell 50%, or the financial crisis where we fell 57%, those look like mosquito bites at this point compared to the long-term picture here. These 23% retracements, while as dramatic as they are, in the grand scheme of things, don't seem that significant. And I guess I'm asking two questions. Number one is, how do you value those retracements as far as weakening of the overall trend? And I guess the second one would be, at what point do we get that 50, 60% retracement like we had back in those two crises early on? Because it feels like it should happen based off normal market price behavior.
Well, I think the market kind of tells you what it's going to do, right? Again, that's one of my philosophies. I don't try to tell the market what to do. I listen to what it's telling me. Mm-hmm. And so we had last week we had that large candle, that 9% rally candle. Well, if there's a tool we have on our website, is a 50% tool. If you just do the range of that candle and then divide it in half, in other words, 50%, to me, that telling us is that candle is a very positive candle in terms of strength. And now every time we've come down in the last 2 days to that 50% level, we've bounced off of that. So what is kind of telling, the market's kind of telling you is like, okay, the damage has been done. Here's kind of the range that we can anticipate moving forward. And if price goes below, let's say the 50%, then we'll probably trade in the bottom half of that big, large candle. But moving forward, I really kind of feel the market for the short period, and again, maybe 3 months until we get a better clarity on the tariff situation, we're going to be range bound by what is defined by that candle. Now, in terms of risk, or what do we think about trends, right? Then we would need to see the market go below that green candle, and that would give us our new lower low, and we'd have a lower high. So that would be a confirmation of a downtrend. And so I would continue to be playing the market with downtrending strategies, whatever, selling calls, buying puts,
Mm-hmm.
doing credit spreads when volatility gets wide, all a range of things. And again, I would continue to do that until the market told me that it had found a bottom. Again, I'm not going to try to catch a falling knife. I'm going to wait for the knife to hit the floor before I step in. Now, what would I need to see? Well, I think there's a lot of things we could look at technically, right? We finding a level of demand or support, waiting for momentum to change from a negative to positive, looking for some divergences in some of these momentum indicators like RSIs and stochastics. All those kinds of things we'd look for a little checklist of things, and then that change of character or change breaks the structure of where the market stops making new lower lows, makes a higher low, and then makes a higher high. And
Right.
then that would be the beginning of that new trend.
What's your take on, I guess maybe what's the CMT perspective of the psychology of levels and when terminology changes? So, for example, a 10% is pullback on the S&P would just be a market correction. Once we get down below that 20%, it's now officially a bear market. And, those terms, when they get flooded into the mainstream media, do a wonderful job at precipitating fear. Now, we came down to that 20% mark on the S&P. We breached it, but we didn't close below it, and then it ripped back up. Is there, in your experience, some magic to that 20% line as far as acting as a psychological demand zone until it's no longer there?
I don't, in my personal experience or belief, I don't think so. But I do believe that the media is made to confuse investors or at least make them to make mistakes. And I mean, how many times have you heard, let's say, the market goes down like 2%, right? Okay, yeah, 2% is not a big move, but what's the headlines on the
Yeah,
news stories?
market crash.
Prices plummeted, right? So it draws on the human emotion. So I think again, you kind of got to look at the market from a very technical and analytical and very kind of almost like robot mentality, where
Mm-hmm.
you look at it in terms of, yeah, 20%, but what does that mean? What is 20%? Well, the market was up 75% over the last 3 years, and now it's down 20%. Well, net, I'm up 55%, right? So I think again, taking that bigger perspective to kind of put it into, I'm kind of lost for words here, but you know what I'm saying,
Yeah.
right?
Yes. And I was just kind of curious on that one, just because for me, when I look back at 2008, when we had the financial crisis, we came down to 20%. And as soon as it looked like we were going to close below it, the Fed did an emergency 75 basis point cut. And then it did it again a couple months later, and they did another cut, and it was like, we're trying to save you at this 20% mark. And I was kind
Right.
of talking to my viewers about it. It's like, look, if we get to threaten that we could close below 20% of the S&P, I wouldn't be surprised to see the Fed take some action here. And I guess, maybe that would be a nice parlay into my next topic for you is, what do you think the Fed is poised to do? I know this is just purely speculative opinion, but I'm curious because I'll share some thoughts from one of my top bond guys on the program. But right now, I'm going to go to the CME. We've got a Fed Funds Futures Forecast tool, which I know you know about that one. And by the end of the year, they were pricing in 4, and now it's dropped. Let me see what it's at today. Here's the CME Fed Funds Futures tool. We're back to a 35% chance of 4 rate cuts this year. Pretty impressive. So I'm curious what your take is on the current situation, at least from your perspective of Fed. What do they think they're going to do? Are they going to start slashing rates again to save us?
I think the Fed is kind of stuck in a hard spot, right? I mean, their mandate is full employment and controlling inflation, and there's this kind of where I think we're kind of this tipping point where if they cut rates too fast or they cut too many times, that could create an inflationary problem. But are we heading towards the dreaded R word, right? In a recession? And I think they're going to lean towards the employment side of their mandate. So if we do see a recession, I do think that it will cut. But again, I feel that there is this balance that they're trying to walk this tightrope. And what they're finding is the more they walk this tightrope, they're getting behind the curve. And so that they whatever decision they make was probably going to be the wrong decision, as far as I think. Again, I don't know about 3 or 4 cuts. My question would be is why would they make those cuts? Certainly, if we do get tariffs, that's kind of inflationary. You look at how the dollar is falling, that's kind of inflationary. So I don't see inflation falling. So then the question is, are they cutting for the right reasons or are they cutting for the wrong reasons? And that makes me kind of think if the market's pricing in those many cuts, then they're pricing in for the wrong reasons. In other words,
Yeah.
slowing growth and recession.
And I think that kind of makes sense if you look at the big picture. Obviously, inflation would be a logical thing with the tariff wars, but that also would be the opposite of rate cuts, right? If you're having inflation numbers, then you want to be doing rate increases. And, I'm playing devil's advocate here because our last CPI number was negative. All right, we're showing deflation on CPI, and on PPI we're showing deflation, and of course 1 point data, which I'm sure that Jerome Powell or Trump is looking at Jerome Powell like, hey, come on, help me out here. I mean, we got deflation. You should be cutting rates to stimulate the market. And while it's not 1 point data, I'm sure that the market's looking at it as like, hey, we should be cutting rates to save the market. And I'm in the camp of I don't think that we should. But
Well, I wonder if this might be a one-off.
yeah,
Again, we're going to hear about a lot of front loading, a lot of people who are buying in front of the potential tariffs. I would not be surprised that the next 2 data points will be more inflationary. Energies came off hard during this last data point, so I think that might have been a little reflective in those. So I would not be surprised that the CPI and PPI actually ticked up come the next 2 data points.
sure.
My concern would be is if you look at, let's say, the ISM and other manufacturing data points, those were showing slower growth, right? So now you got rising prices and falling demand or falling production demand, and that's stagflation. I mean, that's classic stagflation.
Let's look at one more chart here, and I've got the chart of crude oil up here, and this is a large factor as to why those consumer price index numbers and PPI numbers were declining. I mean, this is a big component of it. And yeah, we saw monstrous declines from, $77 down to a low of $55. But now it feels like it's basing a little bit. And I asked you this question, which I did share your response to the audience, but maybe you can, pontificate on it, which was, at what point do you look at the price of crude oil and you say, hey, this is getting near our extraction costs, and kind of anticipate that it's not going to go much lower than where it's at right now. We're at 62.47 on the crude oil futures for May.
Yeah, crude oil and natural gas are very susceptible to recessionary pressure, so we have to respect when we do see them falling. I think the crude oil prices, there was a couple things going on. First of all, the big spike down was some major deleveraging, I think, where we had last week, when we see all assets correlate to one. That's something that is a unique phenomenon to bear markets. But we are at a point, and the majors have been telling us, they're saying, when Trump came into office, they say, well, he wants drill, baby, drill. And they told him, they said, listen, respectful, sir, but, somewhere between $60 and $65, that's what our cost is to drill a new well. And so we're not going to drill a lot of new wells if we can't maintain or support that price. So crude oil markets are very quick to rebalance. Now, I'm not mean like it's going to rebalance like in a day, but in 3 to 6 months, if we have, let's say, prices below, let's say, $60 a barrel here in the U.S. And what we'll see then is that production will drop. Now, what is really kind of interesting is like you think about like shale wells, like in Marcel area, those wells stop their peak production is the day that they tap that well, and within 1 year's time, that production is down about 60%. That means drillers have to continue to drill to maintain production. Well, if the price of a barrel of crude oil is below $60 or $65 for maybe shale oil, then drillers are not going to maintain drilling. And then that will even speed up the drop in production. Now, is this something that could mean that U.S. production is vulnerable to global prices? Yes, but I think in the long term, in the big picture, global demand for refined products and crude oil has been steady, and there's actually a very small growth. So I'm not concerned, especially if we see China come back in their economic growth. I'm not concerned about that. What I'd be concerned of if we do have a major recession and crude oil prices do fall and maintain and stay below, let's say in the low 50s, then that could be something more systemic, globally,
Right.
and that could be a concern for us for all equity prices.
Yeah, it's just so interesting because I guess going into the campaign trail, it was, I'm gonna drill, baby, drill. I'm gonna bring energy back to the United States. I'm gonna drop the price of crude oil, and at a certain point, you can drill all you want to drill, but if the extraction cost is, let's say, $60, or I'll even lower it down to 50, just to be conservative. At a certain point, you can drill all you want. You can open up all the natural reserves you want, and bring in the best technology and equipment. Below $50, I ain't drilling. Doesn't make sense for me to sell my oil. So there does become a floor there, regardless of how much deregulation we get and national, I guess, leases open up on behalf of the government.
That's the big difference between equities and commodities, right? I mean, at some point, the cost has to play into the factor of the price, right?
Yeah. Noam says, aren't we expecting oil at $40 a barrel now? If we are, I would probably be a long-term load the boat type of consumer at $40.
Yeah, I think I would agree with that too. There are dynamic shifts that are going on, right? We're using less oil in transportation because of the onset of EVs and, like mandates in like European countries and things like that. So that mega trend will have an effect on crude oil prices. But in the short run, until we find giant rubber bands for airplanes to wind up the propellers or batteries that don't weigh 8,000 pounds, I don't see how you can not use oil for airplanes and freighters and trains and all those kinds of things.
I do love the doom and gloomers are like, oil's going to go away. It's going to no longer exist. It's like, no, you're missing the point. It's not just transportation. Petroleum products are literally in everything that we use on a daily basis.
Right.
There are a couple questions coming in. You mentioned, so I'm going to go in, I guess, three different areas and try to summarize here. Margaret asks, what's your best inflation predictor? So I'm going to start with that. What would you look at and say, that's my best indicator of inflation going forward? And it's a trick question because there's so many different ways we could approach that.
Yeah.
I mean, if you're Jerome Powell, it's easy, right? Core PCE price index. That's what he tells us.
That's his, right? That's right. His kind of, right?
At least that's what he's telling us.
I think the PPI is a good one because really what you're seeing is that's the origin of inflation, right? How much, your input costs and then how to make those goods, and then they pass that price on to the consumer, right?
Theoretically.
I also think looking at the dollar is a great way to kind of feel out what's going on with inflation. Again, strong dollar kind of keeps a cap on inflation, and now the dollar is flirting with 100. If we could see the dollar fall back down into, let's say, looking at a chart, I'm going to guess somewhere around, 97.5 to around 95, I think is the next level of major support. To me, that would be an inflationary story, right?
Yep.
Again, inflation is what too few goods being chased by too many dollars. Again, if we get some kind of tax cut and we get some kind of rate cut and tariffs don't exist or they come down, well, to me, that's more dollars, more liquidity, and then that also could be a potential sign for inflation.
Yeah, it's interesting when we look at the historical relationships there, and I'm with you. If the dollar keeps falling, then that should be an inflationary pressure for the U.S., right? You have cheaper for foreigners buying our goods and services. It becomes much cheaper to buy more. But the trade wars could offset some of that consumption, right? We're already hearing about billions of dollars lost because foreigners not coming to America and doing their vacations like they used to, which I don't know. I guess I have to trust the media at those facts. But if those factors are true and people may buy less goods and services from America, even though the dollar's falling, that would offset some of that inflationary pressure.
Yeah, exactly. Again, we talk about oil and natural gas. China hasn't bought any LNG from U.S. producers for I think over 90 days now.
Wow.
So they're hardballing, right? So yeah, again, that is actually deflationary, right? Because then the you get this backlog of
Yep.
LNG and backlog of
They'll
natural
drop their
gas, and that could
prices.
drive prices down. Yeah.
Oh, the games that are played. I love it. All right. You mentioned earlier thoughts on stagflation. My viewers know well, but I think we have some new people here today. Stagflation is typically a trifecta of economic forces. You have increasing inflation, you have decreasing growth with this GDP, and you have increasing unemployment. As we stand now, we do have increasing unemployment, but it's ticking up like 0.1% each month. I think we're at 4.2% now, which is fairly low. We have inflation, which is, according to the Fed, under control now. I mean, we're under control. Everything's fine there. And we have GDP, which is limping along under the historical average. Historical average since 1950 is 3.3%. And here we are, I think, with 2.4, 2.5. So those numbers, I'm curious why you think stagflation might be on the table here.
Well, I feel like the recession part of stagflation is more about the consumer. Now, I think we have two consumers. We have most of us are in one boat, and then we have this very high end consumer, right? Let's say, I think they said something like the top 10% of wealth consumers in the United States is 50% of consumption right now. So the wealth effect of the stock market could make those folks cut back on some of their purchasing. That would
Yep.
be a kind of recessionary. Again, tariffs are inflationary, right? The cost of goods goes up. I mean, I've already seen a lot
Yep.
of CEOs are saying, "Hey, you know what? We're just going to pass on the price to our end users, our consumers." And that might not be like you and I consumers, but it could be, just down the manufacturing
Sure.
line. So that, and then, the cost of money, right? Or credit, right? And that is very concerning to me. I see that mortgage rates are back above 7%. There are some weird statistics that have recently come out. More mortgage defaults higher than the GFC.
Yeah.
Credit card defaults are on the rise. Credit card debt is on the rise. So all those things, the cost of money is on the rise. So that is inflationary to me. So I see the two dynamics going on at the same time: potential slowing growth and the cost of goods continuing to go up.
And then, if that happens, dreaded stagflation, we'll make some really cool shirts if we get to that point. What would you, if you're an advisor, right? I've now bumped you up from education head over there at Barchart to you are now an advisor for the Federal Reserve, and we get ourselves in that situation, right? We see growth slowing because I think pretty much agreed that tariffs could hurt domestic growth and that would hurt GDP numbers. You also have the inflation number that could come from that weakening dollar, and that could lead to more layoffs. So the variables are there which could push it. How do you fix it? A lot of things are, a lot of market conditions can be fixed, but stagflation becomes very tricky. What would your suggestion be to Mr. Powell? Because I'm going to forward the show to him.
Well, I think it's out of Powell's hand, be honest with you. I really think it's in the Treasury's hand, which really leads back to it's in the government's hand, and this idea that governing borrowing or the issuance of treasuries is getting so large now because of our debt that we're crowding out capital. I think what we need to do is get the government out of the capital markets, which means balanced budgets and trying to retire a lot of our deficit, which I don't know if that can be done,
Mm-hmm.
but that would be how I would see to relieve those pressures, right? You get the government out of borrowing, then the cost of capital comes down, and then that would be what I would call like a peace dividend, right? In terms of economic activity,
Peace dividend, I like that.
right?
Yep. The old peace dividend. All right. Question from Steven. He said, John, where do you see gains in or grains like wheat, soybean, corn headed over the next 6 months? It seemed like they're pretty cheap. However, if we limit our shoppers with tariffs, could they get even cheaper?
Grains are just a little outside my pay grade right now. I haven't really been watching them, but here's my thought is if China's not buying our grain and they're buying grains from other places, and we've already seen a dynamic shift in, like South America
Yep.
is producing a lot more grain. Brazil is the largest soybean producer in the world. Then that's going to be bad for our farmers, right? And so that might mean less farmers are producing grains. Again, kind of that oil scenario, right? And eventually that cycle goes from where we're not producing any grain to when we need the grain, there'll be a limited amount of supply, which could be inflationary. So, I mean, that might be take two growing cycles for that to happen. Um, again, I think I look at the dollar and just from my old school way I used to trade grains or when I was trading commodities, agricultural commodities is, I would take my cues from the dollar. And so a falling dollar does make, our products cheaper. But if there's 150% tariff on them, it doesn't really matter, does it? How
Yeah.
far the dollar goes.
Yeah. And that dollar's been one that we've been watching with regularity. Here is that dollar chart. I have a 3 year up here, but I could go just to a 1 year. Watching that value of the purchasing power of the dollar fall significantly. I mean, we were at almost 110 just a couple months ago, and here we are now sub 100 at 99.
Yeah.
And it looks like it's going lower. I mean, if I look bigger term, like 94, 93 area is a pretty logical stopping point. And as one of the cornerstones of financial markets, there's always these stupid mantras. I love mantras for a reason, and my favorite is the trend is your friend till the bend at the end. And that dollar index, lower lows, lower highs, no bend in it. It looks like it's going to continue to drift lower and lower. And honestly, isn't that what Scott Besson has said he wants? He said he wants
Yeah.
a weaker dollar.
But then the old adage I always remember with dollars, we used to call it Trixie Dixie too. So just when you think you got the dollar figured out, it makes these massive moves in the other way. So
Love it. Let's look at one other thing here, then I'll see if we got any other viewer questions. You talked about the rebalancing of earnings, the revaluation of earnings, and I thought that would be
right.
kind of an interesting topic. Talk us a little bit about what your thoughts are on not only the earnings that are coming through, but also the revaluation.
Well, we came into this year and all the analysts were kind of saying we're going to have 10% growth of earnings, right? And that's kind of normal, right? I think historically 8 to 10%. But we came into the year with, the forward PE at around 25x, right?
Yeah.
So
Yep.
which is at the high end. I mean, very high end in terms of historical range. So you have normal growth at a high end P multiple. So what I think really what the market is kind of doing is it's like, well, the tariffs kind of shocked everybody. And then also all these CEOs are saying, hey, you know what? Yeah, maybe our growth is not going to grow. Our earnings aren't going to grow 10%. Maybe we're just going to have, 2% or 5%. Or maybe we're just going to hold steady to what we made last year. And so what I think with this now as a market is taking that into consideration is reevaluating what is the estimate for the growth this year. So the estimates again, I think some for the S&P is something like 275, 276. And again, if you times that by 15, which is a normal low end range, that puts us around in that 4,000, 4,100 level. I think at 17x, that puts us around 4,600. So to me, I think the market is trying to find a rebalance because there's still a lot of uncertainty about what tariffs are going to actually do to earnings. We don't know that yet. We probably won't know that until the end of the year.
Yeah.
But the market, I think, is recalculating that value, and I think what it is going to do is going to bring the forward PE below 20, somewhere back to a more historical level, normal, which would be something like 17 or 18, or maybe at a discount, what I would think is around 15.
Yeah. Yeah, I think the historic at 15 to 18, somewhere in there. So getting us back to normal is probably logical. And there is that elasticity to markets that I know you're a fan of where you see something get a little bit too overheated and you're like, I know it's going to snap back to its, long-term average price here. And I guess we'd be remiss if we didn't bring up the conversation of gold, which is at all-time highs. And if we were to put some technical indicators on that gold chart, it just keeps going. and going and going. So I'll bring up GLD just because it makes it easier for me here on these charts. But what's your thoughts on gold here? Is this a buy with caution or load the boat, back the truck up?
Um, yeah, I'll be honest with you. I kind of had predicted early in the year, or at least I had targeted that I thought we were going to get just to about 300, around 295, 297 versus the GLD. So this last move, especially this big breakout move today, th- if I had a gun to my head and you asked me what I think, I would think that this might be a beginning of a blow off move.
Mm-hmm.
But again, you know, we're in a totally new dynamic, right? We don't know what's happening. And if money is coming out of US equities, and there's a lot of money that's been in US equities for the last, 5 or 6 years, is this a function of money finding a place to come home to, right?
Right.
And
Right.
again, you hear all things that China's taking money out of treasuries and buying gold reserves. So who knows? I mean, maybe gold goes to 4,000. I mean, all the gold bugs would love me to hear that. But to me, when gold is such kind of a static market, it takes so long for it to make dynamic moves. And you think about how much it has gained, let's say, in the last year, or even in the last what was that 7 trading days? It's gone from 275 to almost 310.
Yeah.
I don't know what that is in a percentage, but um, that is probably a
Twelve point eight
percentage.
percent. I got it up in
How much? 28?
No, 12.8%. If you go to the lows, we were back on the 7th of April. So here we are, less than 10 days later, business days, not trading days, 12.8%. For gold, I mean, that's a hell of a move. I mean,
Yeah. But if you think of it in the dollars, it's probably fallen about 8 to 10%
yeah.
too during that same time period. So that kind of makes sense, right?
Yep.
But again, to me, I mean, I would not be buying it here. Matter of fact, I sold some calls and they're going to get exercised tomorrow. So that's so be it. I mean, and I'm going to not have a gold position, which I don't like not having, but I'll probably wait for a dip and buy it. Again, if you talk about reversion to the mean, if you put a Bollinger Band on that one, I'm pretty sure
The
we're
mean is
way
if you look
outside
at
that Bollinger Band.
GLD, yeah. So I don't have Bollinger's on here, but I've got the chart up, and this is kind of what I was referencing earlier, that elasticity of price. If we go back, let me make this a 1 year chart, and you guys can see that back here in 2024, in like July, it was pretty close to the moving average. It started to separate in August, September. It got a little bit high above it here in October of 2024, and then came right back to the average. If you look at the extension, the distance by which we are above the moving average right now, and I've got a 50-period moving average, but you can pretty much use any of them, we are very stretched out. And Margaret, I think with Margaret just mentioned, was it? Make sure I get the right name here. Talking about shorting gold. Where was it? Okay, never mind. I'm trying to read here too quickly. But one of the viewers was out to say, look, I was looking at shorting gold, but I just didn't. Oh, there was Lisa. Says was possibly going to short gold. And I think you're probably in the right frame of mind. We do have this overextension, this run to gold. It's just the question of how high can it go. As John said, it could have a blow-off moment, which means this thing could all of a sudden have a 10% update for no particular reason. And you'd hate to be on the wrong side of something like that. But I agree with you, Lisa. I think this is coming back down to the moving average and continuing to trend up. It's just due for a correction here. That's way too much inflows, and the volume at the bottom here will confirm that. I mean, we've got way higher volume over the last 3 weeks than you normally do. So I'm not trying
let
to
me just
short
let
that
me
one.
just convey what I see on my chart. I have a Bollinger Bands on its 2 standard deviation where the mean is 20-day period. So the outer band on the upside is 303.33. So we're way above that. And the mean is at 285.80. So again, I wouldn't be standing in front of this and saying I'm going to short this. I certainly wouldn't buy a market that's outside of its Bollinger Bands. What I would be waiting for is the market to fall back inside of the bands, again, below 303, and then looking for that mean reversion,
Right.
which is an upsloping 20-day moving average that's going to go up every day. But if you look at where this explosive candle where we broke out of this most recent range, looks like around 289. So that would be where I would be looking for a buying opportunity, somewhere between 285 and 289.
Yep. Nope, there you go. And I threw those Bollinger Bands on there to confirm it. And, and you've got to be careful here because based off what John said, and I agree with him 100%, I think that's the right way to approach it. You're waiting for confirmation. Just because something's outside of its upper Bollinger Band doesn't mean it's going to come crashing back. And if you want proof of that, just go back a couple of days, literally 3 days ago to the 11th of April. We gapped up outside the Bollinger Band, formed a little tiny, what was that one? It's not a death cross. It's a tiny little shooting star. It's just this little...
doji shooting star.
Doji cross, and the next day, okay, you got your confirmation, and it continued on up. So at some point, it's going to break. I just don't want to be the one that's continually trying to short gold on this rally up here because, as John Maynard Keynes would say, markets can remain irrational longer than you can remain solvent.
You can solvent, yes.
Which is very, very true. What else is on your plate? I know you talked about having some, you took your break from the webinar today, but you got some stuff coming up here in the near future. What's good and fun and happening over there at Bar Chart?
Yeah, so again, what we're doing now is we have our Wednesday shows is for the general public, and it's more of an educational webinars. We look at a lot of different things: technical analysis, market concepts, options, everything. It's a wide range of subject matters. So the next two subject matters that we have is I'm doing one, a multiple time frame analysis, and this kind of idea of fractals. In other words, how markets repeat through time, and that it's not all about trend, but if you can find, let's say, a higher time market fractal that rhymes with, let's say, a lower time frame, what you can find is really good trading opportunities where you have a lot of low risk and a lot of greater rewards. But when you can find lower times that correspond with higher time frames, then that increases probability. And that's our mantra as traders, right? Low risk, high reward, and high probability. So that's what that one is. And then the following week, I'm going to do one that's kind of a little bit outside the box. It's going to be looking at value investing, and we're going to look at some stalwarts of value investing: Benjamin Graham, Warren Buffett, John Bogle, the founder of Vanguard. And then we're going to contrast them to something called the EMH, which is the efficiency market hypotenuse. It basically says that all information is already discounted in price, and so there's no advantage to timing the market. There's no advantage in technical analysis, but it has a difficult time explaining things like bubbles and crashes and things like that. So we're going to compare and contrast them, and then look at some metrics to help folks use for valuations in terms of looking for value stocks.
Nice. I like it. You got a tremendous amount of archives over there too. So I had the webpage up there. If you just go to barchart.com, there's a little button there that says learn. If you click on that one, you'll see upcoming webinars. There's also a bunch of archive stuff as well that you can learn from.
Yeah. And the other exciting news, Merlin, is that our Friday show is now being streamed on through our X account. So if you're not a subscriber of barchart.com, or you follow us on X, you can watch that Friday show where we get a little bit more into the alpha. In other words, we look for opportunities, we look at how to use some of the tools and features on Barchart to find trading opportunities, and we kind of look at the big picture of what's the market's doing, and see if we can kind of put all those pieces together. So that's really exciting because we're really getting a wide range of viewers. So that's kind of exciting for me. Makes me a little bit more, make me work a little bit harder and make sure that I put out good content.
Well, just don't forget us little people, huh? Hey, when you want to do a webinar on digital assets, let me know. I think that might be one that you guys might find interesting. I know that you've got the monopoly on those webinars, but maybe I'll come on and help you guys out with some of that, because
I'm definitely interested in about, maybe you can give me your 30-second synopsis here. It seems like Bitcoin is like taking the back seat in the crypto space right now, except for when Michael Saylor buys another 2,000 coins or whatever. But it seems like it's all about Ripple now. It's Ripple this, Ripple that, Ripple this, right? Is that the XRP?
Look, when you have 42 billion tokens that are worth about $2 a piece, it gives you $80 billion worth of value to lobby politicians to basically they're unloading this every day on the market as well. There is a project out there called Ohm. Mantra is the name of it. The symbol is Ohm. And the insiders there own 90% of the project, and they just dumped it. And the stock dropped 90%, or the project dropped 90% in value. So one of the things that I look for in my classes is tokenomics, right? It's one thing to understand what Ripple does, who's they're controlled by, what their plan is, what their approach, their team, the development, roadmap, all that stuff. But if all of a sudden you realize that one individual, one entity's got a giant chunk, it's just a risk vector that you have to eliminate. And to me, Ripple is just way too much of a risk factor. Plus, I wouldn't even call them a cryptocurrency. They're a publicly, or they're not. They're a company that is controlling a digital asset. They are the ones pulling the strings. When you look at Bitcoin, no one controls it. You look at Ethereum, the community controls it, and it's all over the world. With Ripple, you've got Ripple Labs and 4 or 5 entities that control Ripple. So it's nothing more than just a normal business. And so I own Ripple in full disclosure, but I'm not a fan. You said Bitcoin taking a back seat. It's actually performing way better than every other crypto out there right now. Even though, all of crypto is down, taking a big sell-off over the past couple months, but I wouldn't bet against Bitcoin at this point. And then I was supposed to ask you.
It fell back to that number we looked at, I think, the last time came on the show, that mid 70,000
76,
level.
yeah.
Yeah, and it bounced like a champ. So, and then you talk about, how can you decide if the market is bottom or has changed direction? Well, I mean, it's still making lower lows, right? But it's kind of feeling like it's starting to try to make some higher lows, or excuse me, higher highs. It certainly feels sideways to me at the moment. So,
what, crypto or the equity markets?
Bitcoin.
Yeah.
Saying.
Yeah, it feels like it's starting to stabilize, which for me is a great thing. I'm definitely a fan of stabilizing prices. So, we'll see what happens over the next couple of weeks. But you have an avalanche of positive news. There's almost nothing I can look at on the horizon that is negative about Bitcoin. Yet here we are down 20+%. Seems a bit odd.
Well, let me throw the table at you and ask you. Well,
wait? Am I on your show? What's going on here?
Yeah, exactly. You have any concern about the risk off aspect? Let's say the deleveraging, right? You saw what happened on, was the beginning of last week, right? Where we saw deleveraging across the whole board. Do you have any fear that there could be a deleveraging in Bitcoin and that a risk off scenario? Let's say we have a worst case scenario in that, and the stock market where we do fall down to like that 4,000 mark. Could Bitcoin be coming to an end of a cycle where it could have one of these? I mean, you know the history more than I do, but there are times where it does have these 50-60%.
It's supposed to start in November.
Drawbacks, right?
Yeah, 70 to 80%, and it's supposed to happen in November is when it starts, and it goes for 12 months, which is, and again, I don't understand why these numbers happen, but it's happened over and over again. The videos I actually recorded for you guys have a lot of charts that outline that. The deleveraging of it, I'm not concerned with. The only thing that concerns me about Bitcoin is the fractional reserve lending that's going on at institutional level, which no one's talking about, where John Rowland deposits 100 Bitcoin at Coinbase, and now Coinbase says, okay, if my customers want to buy Bitcoin, I don't go to the open market and buy it. I'll just move it around as a ledger entry on our books. So my guess is that these exchanges probably have 10 times more Bitcoin than they actually have because they're leveraging it out. Because there's no way Michael Saylor can go out there and buy $5 billion worth of Bitcoin on the open market and not move it. It's mathematically impossible. There's just no way it can happen. So there has to be some shenanigans going on behind the scenes, and that's the part that concerns me is this fractional reserve lending.
It makes sense. I mean, again,
they do it with our money.
Things in the market that I don't think we know, but the way the market is reacting in these times of stress tells me that there's something else behind the scenes that we don't know what's going on, right, and that there could be another shoe to drop, so to speak.
And that's how these businesses make money, right? I mean, Coinbase, Kraken, Binance, Gemini, Fidelity, they don't want us to know what's going on behind the scenes in totality. That's how they have their edge, Steven here says, if MicroStrategy goes under, it will be a major deleveraging. Yeah, it will be a catastrophic market event for crypto.
Yeah.
And that's another one. Is that a house of cards? And we can talk at length about that if you want another time, but that to me is starting to smell a little fishy with what's going on with Michael Saylor and Bitcoin. But for now, I'm okay with it. I think we've got a lot of positive things in front of us, so looking for it. And are you a fan yet? Or are you still just on the sidelines going, nah, not trusting it?
I came into it at the beginning of the year, I allocated a small portion of my portfolio towards it, but again, I used my risk management tools and where I got in, and then I got stopped out, and now I'm kind of waiting to see. So, I think you have to have a piece of crypto in your portfolio,
Yep.
just like you have gold and real estate and life insurance and all those other assets. In part of your bigger picture of your wealth bucket, so to speak. So yeah, I mean, am I a fan? I probably would be looking at one of these ETFs that has a mixture, not maybe just Bitcoin, but has a mixture
Mm-hmm.
of some of the more larger market cap cryptocurrencies.
Yeah. All right. Well, time will tell. I mean, we don't know exactly what the future holds. I do think it's going to become much more of a digital world, but that's it's funny. I just got an alert about one. I have a little app on my watch here, and it says Engine, which is a crypto that I'm in. Get this, John. How much do you think it's up in the last 50 minutes?
I have no idea. 2,000%.
119% in the last 50 minutes. That's crypto for you. Buckle up. If
Yeah.
you have ulcers, stay away from crypto. If you have
Right.
anxiety, stay away from crypto. All right.
At least you go to Vegas, right? You get free drinks, right? So,
They're not free anymore, bud. They're not free. Well, I guess it depends which casino you go to, but yeah.
well, that's all full disclosure. That's why I have a large put spread on Las Vegas Sands, so, because I've heard a lot of bad things about what's coming out of Vegas right now.
Didn't they just report earnings today?
I don't know. I think it's coming up maybe in a couple weeks, but actually, my co-host on our Friday show, he's going out there. He's going to do a little in-depth research for me.
They're supposed to report today,
Yeah,
but they
we'll see
haven't.
what
They
happens.
delayed it. Yeah. He's
Oh,
gonna
they
do
delayed
first-hand
it?
research. Well, it said BMO yesterday, and today now it has a dash as a no reporting, which means they delayed it for some reason, which is not good for Las Vegas.
Yeah, that's not a good sign, right?
All right. Well, I hope he has a good time out there in Vegas. I appreciate you coming on and sharing some insights, and look forward to your upcoming webinar. That should be a pretty good one.
I appreciate it, brother. I always enjoy having time with you. I feel like I need this little camaraderie that you and I have. So it feels good to be back in the saddle, so to speak, with you. So thanks so
absolutely.
much for letting me
Anytime you want to come on, you're always welcome. And thank you for coming on. I appreciate it.
in. All right, Merlin. Until next time.
All right, take care. Guys, that was John Rowland of barchart.com. You can find out more information by going to barchart.com, clicking on Learn, and you'll find all the information about his webinars and other pieces there. So, that was fun. There he is. Nice John Rowland picture there. Financial market deep dive. We went into a lot of different things. We could obviously go hour after hour after hour on that one, but I wanted to go kind of high level here. Interesting. Always pieces I learned from John. I will be actually focusing a bit more on the energy side and oil, which has been a cause for the deflationary numbers we saw in PPI and CPI. Looks like it's stabilizing. I may actually start to build a position here, even though I've told you my bias is to the downside on crude oil because of the drill baby drill. But if we get past that floor, and it sounds from what John's saying, right around that 60 to 65 mark, which we're in, then that's the bottom. So who knows? Might be something I add as a side play to me on my trades. Let me run through your real quick market recap here just so I can get the numbers out of the way. I did open up some new positions today. I sold the 100 strikes on Nvidia today. Collected $1.40 per contract, which is great. So that's a nice 1.4% rate of return. They expire tomorrow, so we'll see. Again, I'll bring up the Nvidia chart here, which I can show you right there. I mean, earlier today, it was selling off pretty good, and we were very close to 100, so I sold the 100 strike and got 140. We're currently at 103.58. We'll see if we get down below 100 tomorrow. If we do, then I'll be a holder of some nice quantity of Nvidia. Now, I want to run through our top parts here. The NASDAQ obviously is the worst performing market. Thanks to Jerome Powell for making some pretty negative comments about the market and the impact of tariffs and just the uncertainty. NASDAQ was down 3.03%. S&P was down 2.26%. Technically, none of them are really saying anything other than they rallied up an overhead supply and are now selling off. But as John mentioned, staying above that 50% range of this big green candle from April 9th is a very positive sign, and for now, we're maintaining that. Looking at the 10-year yield, we've also witnessed 3 big down days in a row. We fell another 1.34% in that yield, so maybe the talk track of the Chinese markets the talk track of the Chinese markets selling their 10-year bonds, maybe that's overdone and stopping or slowing down. Russell 2000, 0.98% slide, but just totally sideways really for the past 3 sessions there. And you've got the dollar index, which we talked about. This one is a bit more concerning. I really don't like this picture here because we've broken down below that little demand zone, which is between 99.60 and 100. And we're now below that at 99.26. So you kind of got to zoom out a little bit here to get to the next possible stopping points. For me right now, that looks to be right around that 98 mark, which is certainly a bit lower than where we are right now on the dollar index. So not a great break there. Top 3, Bitcoin was doing much better earlier in the session, then gave back a bit of its gains. You can see it's got what they call a spinning top doji, which is a topping and bottoming candle. Looks pretty much the same. That was up 0.45%, closing on the futures markets at 84,535. Crude oil with a very nice pop today of 1.86%, closing at 62.47. Right in that range. I'm going to put a yellow box here, and I'm going to dig deeper into other sources, but I do like John giving us some insights as to between 60 and 65 is what producers say is their number for extraction of oil. And man, we're just sitting in the middle of that yellow box right there. I might have to change this one, but not a really good sign there it is a good sign if you're long on crude oil that we're sitting kind of at the lower end of production costs. And then finally, gold. We already looked at gold. We talked about it as a bull flag yesterday's show, and we're getting that break. Let me map out for you what that target price is just so we can see exactly what that number might be. And from the break, which we had today, it looks like your target price here for gold is going to be 35.45, and I'll label that one right there. So 35.45 is your target off that bullish flag formation. Again, I do think the gold is due for a pullback here at some point, but I'm not going to bet against it right now. I would wait for confirmation. As John said, maybe Bollinger Band's waiting for it to come back in. Let it run some more on gold. Yeah, definitely, Rob. You're crazy trying to catch that thing right now and trying to short it. So just don't want to take that kind of chance. So that, my friends, is your top 7. I can go to your economic calendar and tell you what's happening for the Thursday session. We have a refinance rate tomorrow morning at 8:15 a.m. That's going to be for the ECB. They're expected to drop 25 basis points. And then for the U.S., we have some of our bigger news, which is unemployment claims, Philly Fed Manufacturing Index, and building permits, as well as housing starts. So those 3 things happening at 8:30 a.m. Eastern Time. So 1 hour before the markets open. That should all be steering the market for tomorrow. And ultimately, I want to go to that earnings calendar, which I just had up there. And we talked about Las Vegas Sands reporting, but they're supposed to report today. The big one there is Netflix. So you've got Netflix, of course, UNH, which is an important one because it's so expensive. You also have Blackstone Group, American Express, Charles Schwab. TSM will also be reporting earnings. That's Taiwan Semiconductor. There you go. I'd like to see what they say about the tariffs and issues between China and the United States impacting the sales from Taiwan Semiconductor, but they've been significantly chopped here. They're currently at 151, and they were up right around $230 back in January, so a pretty big sell-off there. Could gold be the result of a short squeeze? It certainly could. I think it represents the historical norm of an uncertainty, of a flight to tangible assets where that can't really be as manipulated as the dollar can and these trade tariffs. So that was a question earlier, I believe. I apologize if I didn't get to it right away. There was a question about if the dollar collapses, does Bitcoin collapse with it? I think the exact opposite. Look, if you live in a country that you feel like your currency is going to have a massive decline, you don't want to lose the value of the asset that you have. So what do? You buy something that's scarce, like gold, which is probably why we're seeing gold rally so much. And also Bitcoin could fall into that category. So I think you'll start to see money flow into those 2 assets, or at least money flowing into Bitcoin, because it appears it's already flowing solidly into that gold chart. And that is just a phenomenal run. You usually don't see things like this for gold, at least this pronounced. Over the past 100 days, trading days, 31.8% increase in gold, far outpacing the equity market. So there we go. All right. Dang it. Here we are. 1 hour. SLV, Doesn't look the same. So one of the big things with silver is it's much more used for industrial purposes, and if people feel that industrial activity is going to slow down, then that should hurt silver. Although we've had a phenomenal bounce, over 10% rally from just April 1st. We were down at 27 bucks, and here we are hitting 29.76. So almost a 10. Let's just put the numbers on there. Boom, boom. I'll get to the bottom of the top, get my exact numbers. So 12.34% rally off those lows on silver. Still looks good, but not as strong as gold by any stretch, and I think that has to do with the overall economy slowing down. So there you go. All right, guys, that's going to do it for me. Tomorrow will be the last show of the week because Friday is going to be Good Friday, no trading, so I won't do a show on Friday. So I will have a glass. Do I have a glass of whiskey tomorrow? Thursday? Sure. I'll have a glass of whiskey. I'll make tomorrow my Friday. So hope you guys enjoyed John Rowland. You can find out more information at barchart.com if you have any questions for him or follow some of his materials. If you are new to this program, hit that subscribe button, the like button if you enjoyed today's show. I see we got a lot of people here, so hope to see some more likes today. If you have questions you want answered on tomorrow's show, email me, tradermerlin@gmail.com, right on the screen there, and I will see you guys tomorrow. Take care, everybody.